Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. As I've said here now for many months, the low water mark of the 18th of August last year was pivotal to construction what happened next in this market. Back then, the market failed to break down through the neckline, currently at 837, which is highlighted in bright red on my daily chart, of the small but highly influential October 2021 to January 2022 head and shoulders top. Now please bear this neckline in mind. It will inevitably crop up again later on. Anyway, the market chose back then to construct a new pattern, a bull channel. Prices moved up and penetrated the 957 area, the gateway to a congestion area between 957 and 1001, rising and pushing up over the long moving average, currently at 897, plus a lot of the old congestion made out from 2011 and 2012. However, the addition at that time of the long moving average on top of this old congestion managed to erode this rise. And in early October last year, the market broke down and out of this bull channel. A choice now came up about for the future of this market at this point, and this is parallel to what we saw in Chicago wheat futures. Much like Chicago wheat, though, it's not a complete duplicate. And this market had two avenues. And the market chose what I described in my commentary from some weeks ago, and I quote, the straightforward move down with potential targets for the break of the bull channel. Thus, we have a primary target X down in the 903 zone, whilst the secondary, harder to reach target X1 is way down below in the 759 zone. End of quote. In late November, prices reached the primary target at 903 and continued lower all the way down through the 50% Fibonacci line of the August 20 to May 21 move at 900, the 50% Fibonacci line of the September 9, 2019 to May 22 move at 881, the 2013 high at 862 and the 2014 high at 855. But then prices had hit the bright red trend line once again, the one I mentioned earlier, the neckline of the small but influential October 2021 to January 2022 head and shoulders top, and things stopped with the market jerked back up from a small double bottom formed over January. This double bottom caused prices to rise and admittedly reached their primary target for the double bottom, but the rise was eroded by the resistances, trying higher through resistances until it came upon the two combined resistances that it could not overcome. These were the 50% Fibonacci line at 900 and perhaps more importantly the declining medium moving average, currently 863. 4 weeks ago the market gave up pressing higher and dropped, but here comes that red neckline again, slowing the decline and interfering with the decline along with the support from the August 22 low plus congestion at 878 to 791 and 772 and 762 to 765, as well as the 2022 low at 748. And in the periphery, the December 2020 to date uptrend, currently at 750. Now the red neckline has also started to act as a cap on some of the recovery rises, reinforced by the short medium moving average. The result of all this is that what we have this week, a market that has dropped down to the supports and shot up to the highs, trying to find a way out. And captured, but trying to find a way, resulting in this week looking to be a possible weekly key reversal up. Thus, if we close tonight either over 823 or under 798, then we'd be on. At the moment, as I said earlier, we're looking at a weekly key reversal up. Now, this prompts some new questions. If we have a weekly key reversal up, will the bearish pressure of the red neckline and the short medium moving average be enough to hold it down? Will we see an immediate counter, or will we have something else? This has all become very, very interesting, and yet we still also have target X1 below in the 759 zone. Minneapolis wheat. Back in early September last year, there was the start of a new bullish pattern, a bull channel come ascending wedge, expanding wedge pattern, which I've highlighted in dark blue on my daily chart. The rise here was slower here than in other grain markets. In early October, the market broke down through the lower bull channel line and gave us some choices, the same choices that we've seen in Chicago and Kansas City. The market chose the straightforward move lower with potential targets. Thus we had a primary target below, quite a way lower compared to the other grain markets in the 883 zone, with a secondary harder to reach target X1 down in the 840 zone. This market was, as I said, slower, and so it was that prices only managed to reach the primary target in mid-January before moving back up again through February. Now, in the process of moving higher, prices also punched up and out of the upper bear channel line, currently 865 of a newer bear channel that had been constructed since the break lower back in October last year. You can see this as the bear channel is highlighted in bright red on my daily chart. The upper bear channel line had entwined about it during December the declining short-medium moving average, currently 887, but by late January these two had parted their ways, and thus individually they were weaker as resistances. However, 5 weeks ago we received the first glimmer of a new potential bearish pressure. We saw how the medium moving average, currently at 908, capped the market over the week of the 13th to 17th of February. And then the following Monday, the 21st, we saw the start of a new move lower with a combined key reversal down and bearish engulfing pattern. 3 weeks ago, when the market required the upper trend line, currently 849 of the bear channel, plus the 2017 high at 868 and the August 2022 low at 862, we saw some hesitation, which has brought out here, as in other grain markets, the possibility that we may have a bear flag over the turn of February into March. And 2 weeks ago, prices reached down, finally reaching to target X1 in the 840 zone, fulfilling all the targets below for the bull channel, come ascending and expanding wedge pattern. Now this has left us with the previously mentioned bear flag pattern. This has a potential target X below in the 810 zone. And 2 weeks ago we came awfully close to reaching it. Prices dropped even further down to finally fill in the old gap at 817 to 17.5 before trying that, dating from July 2021, and the gap that elsewhere in grains had seen left still open. However, the gap triggered a reactionary move back up, with prices punching up and out once more out of the broken bear channel. There is no weekly key reversal here, and so far prices have not had it tough trying to push up through the August 22 low and the 2017 high. Now this makes me wonder if this is perhaps not so much as a reactionary bullish pressure here as one would expect. This question is still open. I'd like to see how next week's goes. So a question mark on the reactionary bullish pressure here.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.